Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories inside company filings. This time, we're diving deep into T1 Energy Inc.'s annual report, and folks, it is a wild ride with a name change, a major acquisition, and a whole lot of strategic maneuvering to stay on the right side of tax law. Before we dive in, if you appreciate getting straight insights from these dense corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, where we unpack more of these filings and discuss investment strategies. So T1 Energy Inc., formerly known as FREYR Battery Inc., has just dropped its annual report for 2025. This filing tells the story of a company undergoing significant transformation. They changed their name in February 2025, a move that signals a shift in focus perhaps towards a broader energy solutions vision. Now, the big event that shaped much of their year was the acquisition of Trina Solar U.S. Holding Incorporated. This deal closed in December 2024, and it immediately brought a manufacturing facility in Texas into their fold. They're calling this facility G1 Dallas, and it is already up and running at full capacity. But they are not stopping there. T1 Energy is also building a brand new solar cell factory in Milam County, Texas, aiming to be operational by the end of 2026. This move is all about creating a fully integrated US solar supply chain, from cells to modules. They are partnering with big names like Corning and Hemlock Semiconductor to make this happen. This strategy is strongly tied to new US legislation, the Inflation Reduction Act, or IRA, and more specifically, the One Big Beautiful Bill Act, or OBBBA. This new law has put restrictions on solar tax credits for companies with foreign ties. T1 Energy seems to have made significant moves, what they call the FEOC restructuring, to ensure they and their customers can still benefit from these crucial tax incentives. They are very clear that compliance with these new rules is a top priority. Now, let's get to the numbers. The financial tables are always a crucial part of these reports, and T1 Energy's financials for 2025 show a company in a serious growth phase, but also with significant losses. Total net sales jumped dramatically to $755.3 million in 2025, a massive increase from just $2.9 million in 2024. This surge is directly linked to the Trina acquisition and their subsequent module sales. However, a large chunk of this, $586.8 million, comes from related party sales. This means sales made to entities connected to the company, likely Trina itself or its affiliates. While this drives top-line revenue, it's important to watch how these related party transactions evolve. Their cost of sales also soared to $699.7 million, up from just $1.7 million in 2024. This mirrors the increase in production and sales driven by the acquisition. Gross profit, which is what's left after you subtract the cost of making the product from the sales, came in at $55.6 million in 2025. This is a significant jump from a mere $1.2 million in 2024, showing they are making something on the direct sales, but it's important to remember that a lot of these sales are to related parties. Now, their operating expenses are where things get really interesting. Selling, general, and administrative expenses, or SG&A, exploded by 197% to $235.3 million in 2025 compared to 2024. A big part of this increase, $74.5 million, is due to commissions and royalty fees paid to the Trina Group. This underscores the extensive commercial relationship they have with their former parent company. They also recorded a huge impairment of intangible assets, $54.8 million in 2025. This is primarily due to a dispute over a long-term offtake agreement, which led to writing off part of the value of customer contracts acquired in the Trina deal. This highlights the risks involved when acquiring businesses with complex existing contracts. All these factors combined led to a massive operating loss from continuing operations before income taxes of $340.7 million in 2025, a more than 300% increase from the loss of $82.6 million in 2024. On top of that, their discontinued operations, mainly their European businesses, also contributed to the losses, though significantly reduced from the prior year. Net loss from these discontinued operations was $46.5 million in 2025, a big improvement from a $383.8 million loss in 2024. This improvement seems partly due to reduced R&D and a gain from selling land. Ultimately, the company reported a net loss for 2025 of $367.8 million, a slight improvement from the $450.6 million loss in 2024. This is a huge loss for the year, and it's crucial to remember that they are still in a heavy investment phase for their manufacturing expansion. Looking at their liquidity, T1 Energy ended 2025 with about $270.8 million in cash equivalents, and restricted cash. This is a substantial increase from $76.6 million at the end of 2024, which is good news given their capital-intensive business. The financing activities section shows they raised significant capital in 2025 through stock and convertible note offerings, bringing in over $340 million. This was crucial for paying down debt, including extinguishing a large portion of the Trina Solar Ag note and the production reservation fee, which involved both cash payments and issuing company stock. The company is very upfront about its capital needs, emphasizing that building new facilities like G2 Austin will require significant ongoing financing. They are counting on tax credits, particularly the 45X tax credits, to boost their future liquidity. They even sold about $160 million of these credits for $145.6 million in cash, showing how important these incentives are to their financial strategy. Now, there are some significant legal and regulatory risks highlighted in this filing. One in particular is the ongoing issue with US Customs and Border Protection, or CBP, regarding potential customs duties on goods imported in 2024. They have received bills totaling about $25.4 million and are vigorously contesting them, arguing the duties were wrongly applied. This is a substantial amount, and the outcome is uncertain. On top of that, they're facing a patent infringement lawsuit from First Solar Inc., a major competitor. First Solar alleges T1 is infringing on a solar cell patent and is seeking an exclusion order on imported solar cells. T1 Energy Street wrongly contests these allegations and says it will defend itself vigorously. These legal battles are always a significant risk for any company, as outcomes can be costly and disruptive. Another interesting risk factor they mention is around obtaining visas and work permits for their foreign national employees supporting their US operations. They note increasing immigration restrictions and potential disruptions to project timelines and costs if they can't secure the necessary authorizations. And then there is the issue of internal controls. Management has stated that their internal controls over financial reporting were not effective as of the 31st of December 2025. They identified material weaknesses related to general controls and process level controls for revenue and inventory. This is a serious concern, as it means there was a reasonable chance that a significant error in their financial statements might not have been caught on time. They have a remediation plan in place focusing on stronger oversight, better trained staff, and improved its systems, but it will take time to see if these fixes are effective. So, what is the story here? T1 Energy Inc. is a company in rapid expansion mode, building significant US-based manufacturing capacity for solar technology. They are strategically positioning themselves to benefit from new government incentives, particularly around domestic content. The acquisition of Trina Solar U.S. operations has given them immediate revenue and assets, but also brought complexity, including significant related party transactions and legal challenges from customs duties and patent disputes. The ineffective internal controls are a red flag that investors will be watching closely. Their ability to manage these risks, successfully ramp up production at their new facilities, and navigate the evolving regulatory landscape, especially concerning those crucial tax credits, will determine their success. It is a high-stakes game in the fast-growing but complex solar industry. Alright, that is our breakdown of T1 Energy's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.